Hi, hello, this is Melissa, the insurance exam queen, and we are now jumping into a combination of property and casualty basics, and we're going to learn that alongside dwelling and homeowners so that it's all cohesive and it makes a lot of sense. Okay, so we're going to start with the idea of we have a house, and if we have a house, we have the risk of that house burning down, of hail, of wind, of burglary, all different kinds of things can, happen to our house. And we want to know that if something happens to our house, that the insurance company will come in and fix it, rebuild it, whatever it is that needs. We crash our car, they fix our car, the house burns down, they rebuild the house. Okay. And in order to be able to buy insurance on your house, it needs to be your house. Like, you're not going to be, oh, hey, neighbor, let me get some insurance for you. No, insurance requires that you have something called insurable interest. So you need to have insurable interest in your house. Now, interest means that you own it, that it's yours, or that you have a tie to it financially or lovingly even. So insurable interest says that if you're going to insure something, you need to have interest in it. And the interest that you need to have, we abbreviate it as blood, business, or money. So when we think about life insurance or even adding someone to our homeowners or car insurance, you generally need to have blood, as in your family or married, right? Blood, not so much when you're married, but your family, okay? So you can get insurance on your spouse, on your children, because you are married, blood, you are familial, your family, you're related, okay? Business. If you own a business, you own a building that, you sell baked goods, you're a bakery, you own that building, you can insure that building. You can insure that business. It's yours. You have interest in it. Or money. Money is just saying you own something. If you own the car, you have money in that car. That car is worth money and you own that car. So you have money in it. So anything that you own, anything that is yours and it has monetary value, you can insure that thing. So when you call the insurance company, say, I want to insure my house, it needs to be your house. You need to have insurable interest in it. When you say, I want to insure this car, it needs to be your car. You need to be the owner of it. You need to have the money invested in that item. Okay. So that insurable interest says that I own the item. I have blood, business, or money with the item. Now, this can show up as a question a few different ways. What is insurable interest? You have to have blood, business, or money. Or they may say you have insurable interest with all of the following people except. Now, with except questions, they are asking what is not true. So when they say you have insurable interest with all of the following people except, that means that there are 4 choices there. Oh, I love that I have the nail colors like this. There are 4 choices there. 3 of them, you do have insurable interest. So they may say your spouse, your business, your car. If it's your car, you financially own it. It's your business, you own it. It's your spouse, you're married to it. You have insurable interest with all 3 of these. And the except question is saying you have insurable interest with all of the following, except, and that becomes your correct answer. It's the not true thing. It's the thing that doesn't fit with the rest. So the except question is the false answer. So with insurable interest, I've tended to see that question that says, you have insurable interest with all of the following except, and the answer is friends. You don't have insurable interest with friends. You need to have blood, business, or money. But a friend is not someone that you have insurable interest with, okay? Zuzu. Okay. All right, now underwriting. So when you say, I have this house that I want to insure, the insurance company is going to underwrite it. Now, underwriting it is figuring out how risky is it? Because if insurance is the transfer of risks, I'm going to give you my risk of my house burning down. They need to know how risky. And underwriting is basically figuring out how risky. Underwriting is known as the risk selection process. And they're trying to figure out, well, okay, she's got this many accidents. She has this many claims. She lives in this area. There's lots of wildfires there. They're analyzing how risky, how likely I am to file a claim at that property. That's what underwriting is. And if I already have claims, if I'm in an area where fire is common, then I'm going to have to pay a higher premium. I am transferring more risk to them. So underwriting is basically how risky are you? So there is insurance is all about underwriting, and underwriting again is a risk selection process. Even in health insurance, underwriting is, well, how many illnesses have you had? How sickly are you? How old are you? You know, you're asking these questions to figure out how much risk are we actually transferring to the insurance company. Okay, so underwriting is known as the risk selection process. And with homeowners, to do underwriting, they're going to ask you certain things about the house. What kind of roof do you have? What kind of siding do you have? Because when we get into it, let's come down here. Let's talk about basic types of construction. This is what we're underwriting. If you have a house that is fire resistive, it means that it could be burning, that fire can be on it, but that it's not actually burning down. That it can resist the fire, that it won't have as much damage on it because it can resist the fire. So a house that is fire resistive will have a cheaper premium than a house that is known as frame, because frame is just wood, and wood is very flammable. We burn wood on purpose for a campfire. It's very, very flammable. So frame is the worst rating. So underwriting is going and asking the customer, what materials is your house built with? And if you have a house that is built fire resistive, you will pay a cheaper premium than someone who has a house that is just frame, because frame is the worst rating you can have. It is more likely to go up in flames. It can't resist a fire. So poof, where a fire resistive house can stand there for a little bit while the fire is raging and still be okay. So underwriting is asking these questions. Now, there are more types of basic types of construction. If it is in your text, it's not in everybody's text, but if it is in your text, fire resistive, masonry, joint combustible, I don't know all the words, but these are the two that they ask about the most, okay? So knowing that if a house is fire resistive, the underwriting on it is going to be good, because if I were to, oh, perfect, I have everything I need. If I were to take this pen and hold the pen to the lighter for 2 hours, it won't burn. That's what's saying it's fire resistant, that I could hold the flame to this for 2 hours with no melting, no burning. That's fire resistant. Frame, just go right up in fire. Okay. So that's part of what we are underwriting when we are asking about the house. Okay. Now, when we buy our house, and we insure our house, we are insuring it against perils. So like we said, perils is the cause of loss. It's the reason that I'm filing a claim. Peril is the fire, it's the lightning, it's the wind, it's the hail. It's the things that happen to your house or to your car that you would want someone else to pay for, because you're going to transfer that to the insurance company, let them handle the perils. Now, when you buy a policy, it will cover certain perils. Not every policy covers every peril. In fact, insurance will never cover the peril of flood on a homeowner's dwelling. It does on auto, but on a homeowner's, they will never cover the peril of flood. You have to get a whole other government policy to have flood covered. So it's not to say every peril is covered. It's just that a policy will determine if a peril is covered or not. And different policies cover different perils. Different policies cover different perils, which is why there's so many policy options. Why do we have a 2 and a 3 and a 5 if they're all for a regular house? Well, a 2 covers different perils than a 3, which covers different perils than a 5. They all cover different perils. And the policy that you buy will determine what perils and how many perils you get. That's the difference between most of the policy structures. In HO2 and HO3 and HO5, and we'll get more into it, they all cover a house. What makes them different is the perils that they respond to. In HO2 will cover less perils than in HO5. So what makes a homeowner's different is the perils that it will cover. Another thing that makes a homeowner's different is what kind of structure they're covering. A standalone single family house is different than a condo. So they have different policies. A standalone house is one structure all by itself, not combined or touching other structures. Where a condo is like one little unit with a bunch of other units, you only have insurable interest in this unit, and that's a whole different type of policy. So with homeowners, they base the policy not only on the perils, but also on the type of property, a single family home, a condo, and an old house and renters. Renters is weird because it doesn't quite follow the rules of a homeowner's, but it does cover all of your stuff. Okay, so perils. As we talked about, perils are the cause of loss, the fire, the lightning, the wind, the hail. When you buy insurance, you can either get a policy that is named peril or open peril. A named peril policy only covers the perils that are named. A named peril policy only covers the perils that are named on the policy. So basically it has to be listed out. Fire, lightning, internal explosion. Those are the only 3 perils covered on a DP1, which we'll talk about dwelling policy 1. We'll talk about that. But you only get those 3 perils. And if anything else happens outside of that, it's not covered on a DP1 policy because only fire, lightning, and internal explosion are the covered perils. Okay. Now, a open peril, and also with named perils, the memory trick there is if it ain't named, it ain't covered. If it ain't named, it ain't covered. If it ain't named, it ain't covered. It has to be named to be covered. It has to be listed out to be covered. And if it's not listed, if it's not named, it is not covered. It must be listed. It must be named. It must be printed in the insuring agreement for you to know that you have it. Okay. An open peril policy, on the other hand, says we will cover anything that happens, any peril, any potential peril that happens to you. We will cover them all unless we exclude them. So a named peril policy will say what is covered. An open peril policy tells you what's not covered because it will cover anything except what's excluded. So open peril policy doesn't cover everything. There are perils that they say we will not cover this peril. We will not cover that peril. We will only cover certain perils, but it's open to any potential peril that may happen other than these ones. So there's always exclusions. But again, you don't need to worry about exclusions beyond earth movement and fire damage, okay? So with an open peril policy, anything that happens is covered unless it's excluded. And the excluded perils are definitely not covered because they are excluded, okay? So when I buy a policy, I'm either buying named perils, which in order for it to be covered, it has to be named. And if it ain't named, it ain't covered. An open peril policy will cover anything that happens to me unless it's excluded. And the 2 main exclusions are earth movement and water damage, okay? Okay. Okay, I'm trying to think of the best. Okay. Yeah, we'll go into this. Okay. Now, when we are covering our house, whether it's named or open, whatever, a covered peril happens. The physical damage to the property is known as a direct loss. So when the fire happens, that is the direct loss. The direct loss is anything that is happening in the danger zone. And the danger zone is when the fire is raging. Okay, so the fire is raging. Wow, the fire is burning. Direct loss. Everything that is happening in that moment is a direct loss, including the fact that a fire truck is there and is spraying water onto the house. So if a fire is burning in the kitchen and the fire truck comes along to spray the house, because of the way the hoses work and get out the fire, other things in the house will get wet that were not on fire. Okay, so just the kitchen is burning, but they're spraying into the house and the living room is getting saturated. Okay, all the furniture in the living room is getting saturated, soaked, and wet. Now, typically, unrelated to a fire, water coming in, excluded. If your next door neighbor, for instance, took their hose and sprayed the hose into your house, that is not a covered peril on your policy. Now, you could sue them and go after their liability for sure, okay? But outside water coming into your house is not covered. If you left your window open and rain came in, zero coverage. Outside water coming in is excluded. That's the water damage one. Earth movement, water damage. Water damage includes flood. Outside water coming in is excluded. However, why is the water coming in right now? Because there is a fire raging and we're trying to put out the fire. The fire is the direct loss. And anything that is happening in that moment with the fire is also known as a direct loss, including the wet furniture from the fire truck trying to put out the fire. Now, we have a special name for the wet furniture. It is a direct loss. It is. It's part of the direct loss. But because the wet furniture is next to the fire, we say that it's proximate, it's nearby. Proximity is close to or nearby. Okay, proximity means I'm close, I'm nearby, it's close to. So the wet furniture is close to the fire, which is why it is wet. And it is only wet because of the fire and because the fire truck is trying to put it out. So they will cover the wet furniture with the fire claim. It won't be excluded. They won't say, oh, outside water came in, excluded. No, they go, oh my God, the house was burning. We put the water in to put the fire out. Fire is covered. Wet furniture because of the fire is also covered. So we would call the wet furniture the proximate cause of loss. It's next to the fire. It is a proximate cause of loss. But all of that is a direct loss. So the fire is a direct loss and proximate is a direct loss. We're just giving it a special name to say it's not the fire itself, but it's only damaged because of the fire, because of the water on the fire. So it has a special name, proximate cause of loss, but it's all part of the direct loss. So when they say, what type of loss is the proximate cause of loss? You need to choose direct. Choose direct because it's a proximate cause of loss next to the fire. Now, this is where people get confused is the indirect loss. So my house burns down, gone. Furniture is, or whatever, unlivable. Let's say that the house is still standing, but the kitchen burned down. The house is unlivable. It's saturated with water. We've got to make some repairs. We got to do some stuff. The house is unlivable. Everything that was happening in that moment with the fire and the fire truck raging is the danger zone. That's the direct loss. Anything in the danger zone while the fire is raging and the water is spraying is a direct loss. Once we get the fire put out, fire's put out, everyone's okay, we're no longer in danger. Everything that you have to deal with after that, in the aftermath of the danger, is an indirect loss. House is unlivable. I have to stay at a hotel. The cost of the hotel is an indirect loss. The main loss, the direct loss, was the fire. The indirect loss is now having to stay at a hotel because of the fire. So the indirect losses are the things that happen after the main loss, the direct loss. The indirect loss is having to stay at a hotel because the house is unlivable, burnt. Another example of indirect loss, if I own a business, I have a bakery, people come in, buy my baked goods. I have a pipe burst, which is covered. Pipes bursting is covered on most policies. I can't have customers come in because the pipe burst. I am losing revenue. I am losing customers. If my business was open and up and running, I could be receiving customers all day coming in to make money transactions all day. But because the pipe burst, I have to put a close sign on my door. Nobody can come in. The indirect loss of the pipe bursting is loss of profit. I am losing my ability to have customers come in and pay me money for my products and services because I have to shut my doors down because of pipe burst, which is a covered loss. So the direct loss would be the pipe bursting, the loss of income, the loss of profit would be the indirect loss. And both of that is covered on, all of that is covered on the policy. So direct losses are covered and indirect losses are covered. But it is important to understand that indirect losses are only covered if the direct loss is covered. So when I say a house burnt, you go to stay at a hotel. If I say the house flooded, is there any hotel? No. You can only trigger an indirect loss coverage if the direct loss is covered itself. So there is no money to stay at a hotel if there's a flood, because flood is excluded. But there is money to stay at a hotel if there's a fire, because fire is covered. Okay. So the direct loss is anything in the danger zone. The fire is burning, the fire is raging, the fire truck comes along, sprays the water, proximate cause of loss, all the furniture, all the wet furniture is a proximate cause of loss, part of the direct loss. You're in the danger zone. Once the fire is put out, okay, no one's in danger. The house fire is put out. Everything that happens after that is the aftermath, the consequences. Staying at a hotel, loss of income are the two main examples of that. Okay. And indirect loss is known as consequential. It's a consequential loss. Some people try to say the wet furniture is consequential. And yes, it is. Okay. Yes, I get it. It is a consequence of the fire that the furniture is wet. But in terms of the insurance exam, we don't talk about it like that. Okay. We say the wet furniture is proximate and thus direct. The proximate damage is part of the direct damage. The consequences are things after, the things that happen after. Okay. The aftermath, having to stay at a hotel, and loss of profit. And that's such a sales point. People don't realize when you're talking to people and you're selling them insurance, if your premium is higher than someone else's, but you took the time to explain the policy to the person in a way that they understood it, they are more likely to buy from you than the other guy. People, I know we tend to think people go for the cheapest, but that's not true. People go for what they understand, what they get. My friend works for State Farm. She talks up State Farm policies as if they're the only ones that cover certain things. Not that she lies or anything, but she's like, well, at State Farm, we want to provide you with the best coverage. So we make sure that you have money to stay at a hotel if your house were to burn down. The way that you word it and phrase it to people is important. And when you say, oh, well, you have to buy homeowners because you have a mortgage, so you better buy this. They're going to buy it? No. But if you say, you know what? We're going to make sure that after a fire, you have a hotel to stay in. We're going to make sure you have money for that. They're way more likely to want to buy a policy from you because you explain to them the coverages. So it's important to talk about indirect losses, because people maybe, well, oh, the house burned down, but have you thought about what you're going to do If your house does burn down, do you know where you're going to stay? Do you have the money to stay there? I got a policy for you, right? So you want to be able to talk about these things. Okay. Anyway. All right. Now, this is kind of unrelated to homeowners and dwellings specifically, because homeowners and dwelling are both specific insurance. But in the world of property insurance, you can either have blanket or you can have specific. Now, blanket insurance is literally like, I want you to think of a blanket covering everything under the blanket. So if I, for instance, have jewelry tends to be a policy that is blanket. And what we do with jewelry is we say, okay, put all the jewelry you have on a table. How much money does it all add up to? $5,000? Cool. We're going to take a blanket of $5,000 and lay it on this jewelry. And if any of the jewelry is lost or stolen or whatever, you can claim up to $5,000 because that's the blanket of coverage that you have. Specific insurance would say this ring is covered for $5,000 and you can only claim up to $5,000 for this ring. This necklace is covered for $10,000 and you can only claim up to $10,000 for this one necklace. Or this ring is covered at this blanket will say all of it is covered up to $5,000. Specific says this one thing gets this amount of money, this one thing gets this amount of money, and this one thing gets this amount of money. It's separate and specific. Each thing gets its own amount of money when it's specific. Blanket says anything under the blanket is covered. Anything under the blanket is covered up to that amount of money. What you need to remember for blanket is exactly what I have typed up here. When they talk about blanket and specific, it's hard to tell what they're saying. It's like when you read the definition, you go, I don't know if that's blanket or specific. These are the word choices that they will say. When they're talking about blanket, they're going to say single policy, multiple classes. Blanket is a single policy with multiple classes. So when I say a ring, a necklace, a bracelet, these are like different classes. They're different things, but it's one amount of coverage. Or another way, you can have coverage on a building. When you have coverage on a building, you're covering the building itself and you're covering all the stuff inside. So you think of a call center, you have the building and then you've got the furniture and the computers and the telephones. The building is the structure, the stuff inside is the stuff, the furniture, the telephones, the computer equipment. Insurance policies will generally separate these into two separate classes. The building, personal property. So the structure, personal property, they keep them separate. Those are two separate classes. On a blanket policy, they keep them together, but they will say, you have up to $500,000. You can use it all for the building. You could use it all for the stuff inside. But if both are damaged at the same time, you still only have up to $500,000. A specific policy will say the building gets $300,000, the stuff gets $200,000. If the building burns down, you get $300,000 to rebuild the building and that's it. If the stuff is stolen, you get $200,000 for the stuff, but that's it. They don't get to crisscross and take each other's coverages where the blanket can. When you think of two people lying on a bed, they share a blanket. But one person could take the full blanket, or you could do I've got 70% of the blanket, I got 30% of the blanket. That's how blanket insurance works. The building could take it all or some of it. You could share all of it, half and half, whatever. But the main thing is knowing a blanket is a single policy covering multiple classes. A single policy covering multiple classes. You put a blanket over two people, multiple classes sharing the same blanket of coverage. Single says we all get our own blanket, our own bed. It's one thing covering one thing. So with specific, they're going to say certain or a unit. Like this one unit, this certain thing gets its own certain amount of money. Okay. All right. Now, whether it's blanket or specific, whatever, When you are covering your house, they are going to cover, they're going to ask you, how do you want us to cover it? Now, the house itself, the walls and the roof, on pretty much every policy except a DP1, which we'll talk about later, they're going to cover it at replacement cost, which means the exact money they need to build that building fresh and new again. That's replacement cost, because you can't build a house with used wood. Your stuff inside, your furniture, your clothes, your pots, your pans, they're going to give you not the brand new value of it. They're going to give you the used value of it. Because when you buy a TV, you take it out of the box, you touch it, you use it, it loses value. Even if you go to buy a brand new car, if I go to buy a car, the replacement price of that car is the brand new value of that car. But as soon as I drive off the lot, it's in my name, I drive it off the lot, it immediately loses value. Now it's actual cash value. Actual cash value is when you drive the car off the lot. It's not worth as much as the brand new value because you own it now. The fact that it has an owner dings the value down. So replacement is the brand new value. Walk into the dealership, buy a brand new car. Actual cash value is its lost value. It's been owned, it's been driven, someone else has touched it. Loss valuation is determining, are we going to use replacement or are we going to use actual cash value? So when they talk about loss valuation, it is a factor in determining the premium. They are valuating the loss. Loss valuation is valuing the loss. Are we valuing this loss at the full replacement, buying brand new wood, brand new ceiling, brand new carpeting? Or are we valuating this loss at the used value, I drive it around value? I've used this TV, it's got my fingerprints on it. Loss valuation is asking that. Are we going to cover it at the brand new value or are we going to cover it at the used value? When they ask about loss valuation, you just need to know that it's a factor in determining the premium. Because if I say I want the brand new value, my premium will be higher. If I say I'm okay with the used value, the driven off the lot value, then my premium will be lower because they're going to have to pay me less. If we think about a car, I don't know, you just bought a brand new car off the lot for $25,000. The replacement is $25,000. The used value will get lower and lower over time as the car gets older, yes. But let's say in the first year, the actual cash value of your car is like 18. If I have insurance for $25,000, I'm going to pay a higher premium than someone who has insurance for $18,000. So loss valuation is a factor in determining the premium. The more money you want me to pay after the claim happens, and replacement means you're going to have to pay me more money because that's a brand new value, the higher your premium is going to be. But if you want the used value of your items, the driven off the lot value, then your premium will be lower. So loss valuation is a factor in determining the premium. Now, we've already been talking about these, but we're going to dig a little bit deeper into them. Replacement is the brand new value. So replacement is brand new value, brand new price. And the thing is that brand new to replace things at the brand new price to replace things at today's prices. I want to say the price the same, like, kind, or quality. How do I say it? Sorry, I want to add that in there. The replacement is the brand new price to replace the same kind or quality of the thing. How do I say that? The brand new price to replace with similar, same kind or quality. At today's, okay, that's a little bit better. I might edit that later. But anyway, with replacement, It's the brand new value with this similar like kind and quality that you can get. There may be something that's no longer produced and you just have to go with the next best thing. Like if you have a TV from, the 90s, those big, huge box, or maybe they started in the 80s. I don't remember, these big, huge box TVs. TVs used to be these massive things that weighed thousands of pounds. If you have that on your policy and you have replacement price, I promise you, they're not buying you another box TV. They're going to buy you a flat screen, thin TV, because that's what we make today. There are certain things that may be irreplaceable because they're no longer produced, but the goal of replacement is the next closest thing at today's prices. So similar, like, kind, and quality at today's prices, the brand new value. I like to say replacement is the best buy value. What you would have to spend when you go in to buy Best Buy, and then actual cash value is the used value, the goodwill value. So when you buy a homeowner's, because this chapter we're also talking about homeowners here, when you're buying a homeowner's, the walls and the roof are going to be replacement. They can't not be replacement. They can't build your house with used wood, used roof tiles, used plumbing. They can't do that. They got to do brand new stuff. Now, this actually means that replacement price and having that on your homeowners defeats indemnity. And this could be a test question. We talked about indemnity as restoring value to bring a person back to whole. So if I have a 3-bedroom bathroom house and it burns down, they rebuild me a 3-bedroom bathroom house. They restore me back to whole. But here's the thing. What if my house was built in the 70s and it's never been updated? Green shaggy carpet, orange cabinetry, yellow stove, linoleum flooring, never been updated, outdated from the 70s. The value of that house, if I were to try and sell it, would not be as much as if I had a brand new, just built 2022 house. So if I have a 1970s house and I try to sell it, maybe I could sell it for, like, depending on your neighborhood, right? Like maybe 200,000. If I had a brand new house built all fresh, I could maybe sell it for 350,000. So guess what happens when that 1970s house burns down? The insurance company can't build me a 1970s house. They're going to build me a 2022 house. I will have a lot more value in my house if it burns down from the 70s and they rebuild me a 2022. That defeats indemnity. It allows you to profit. It allows you to make money. Your house becomes way more valuable if it is built brand new than when it was in the 70s. So replacement actually defeats indemnity. Replacement goes against indemnity, but there's nothing they can do about it. They have to insure the house at brand new value. Now, what they do is this: they keep it at the same size, right? If you have a 3-bedroom, 2-bathroom house, you're going to 3-bedroom, 2-bathroom house. If you have, when you call the insurance company, remember with underwriting, they ask you about the house. What kind of flooring do you have? What kind of carpet do you have? What kind of paint do you have? What kind of fixtures do you have? Chrome or brass, they ask you these questions. So when they do go to rebuild your house, even though they're building it brand new, they're going to keep it at the same level of what you have. And what I mean by that is if your house has, like, Formica countertops, which is like the cheapy wood countertops, and they go to rebuild you a house, they're not going to put in granite. They're going to put in, the whatever is the similar to the Formica that you have. Okay. Now, if you do have granite countertops and the house burns down, they will rebuild you granite countertops. They're going to keep it at the same level. Like when you go and get a car, they're like, this is the base model, this is the mid-range model, and this is a super luxurious model, right? They ask questions about your house to see if it's a basic model or, a middle model or a luxury model. And your insurance will also be based on that. So that's how they keep replacement as close as they can. If you have the cheapy fixtures in your home, the new one they build you will also be the cheapy fixtures too, but it will still be brand new, which makes it a lot more valuable than if you had your house still from the 1970s. So replacement defeats indemnity, but there's no way around it. So every homeowner's usually is going to be, no, every homeowner's is except DP1, which is a dwelling policy, but every homeowner's you have is replacement on the outside, actual cash value on the inside. Now, actual cash value is the used value, the goodwill value. It's if I buy a TV at Best Buy for $1,000 and I use it for a little while and then I go to sell it, I could sell it for like maybe 600, not 1,000. Best Buy price is $1,000 TV, brand new in the box. Actual cash value is taken out of the box, has some fingerprints on it, been used for a while, $600. That's the actual cash value. Now, to determine actual cash value, we do replacement cost. What is the brand new value? How much would it be to buy this TV brand new? Minus taking away the fact that you've touched it, that you've used it, that it has wear and tear, that it has depreciation. That will determine actual cash value. Because if you think about like even just an item of clothing, if you buy a brand new item of clothing, you wear it, you stretch it out, you wash it, it fades a little bit. No one is going to pay the brand new price for that piece of clothing unless you're some famous person raffling it off. No one will pay the brand new price for your washed and worn clothes. They're going to pay you the used value. So the actual cash value is okay, this dress was $100 brand new, but you've worn it, you washed it, it's got cat hair on it. The best I can pay you is, $60 for it or whatever. So actual cash value is considering the brand new value minus the fact that you've worn it, that it has wear and tear, that it has depreciation. We subtract that from the actual cash value, and that will be from the replacement value, and that will equal actual cash value. So actual cash value is replacement cost minus depreciation. Actual cash value is replacement cost minus depreciation. And with actual cash value and replacement, either one, we do not care about the original value. This would be like saying, well, in the 1970s, I bought my house for $40,000. And in order to rebuild it today, it's going to be $200,000. I don't care that you only paid $40,000 back then when you were able to buy a house with dimes that you collected. Like back then, it was so much easier to buy. That's the thing with like minimum wage and all this stuff. People like, it was a lot easier to be 18 on your own and to buy certain things because it was easier and cheaper. We can't compare the 1970 value of a house to today's prices because the value of wood has gone. Everything is inflated. We need more money to do certain things. So I don't care what the original price was. I don't. All I care about is how much would I need to get that thing today at today's prices. That's replacement cost. They will put in the original price in the question to throw you off. Because they may ask you a question that says, you have an antique dining set. You originally paid $40,000. The current value of the set, the replacement of the set is $50,000. In fact, replacement is usually going to go up from original. Because in order to get that same set, you need a lot more money nowadays. So a replacement is usually more than original. But they're going to give you a word question. They'll say the original price was $30,000. The current replacement is $50,000. It's depreciated $200 every year for the last 5 years. And then it burns in a fire. How much money you're going to get? You delete the fact that they tell you the original price. I don't even care. I don't care what the original price was. Throw that away. How much money is it to replace it right now? Minus if they say, okay, so let's say we're going to do nice, easy, rounded numbers. Let's say that it was the replacement is $1,000. They say that you had an item burn up in the fire. It's $1,000 to replace it. It's 2 years old. And each year it has depreciated $200. Replacement price minus wear and tear equal $1,000 minus 200 for 2 years equal $800. Did I say that $100 each year or did I say $200 each year? I don't remember what I said. Sorry. Let me redo the numbers. $1,000 to replace it. And it has lost $100 of value over the last two. Every year it loses $200 of value. 200. Okay. So year one, $200. Year two, $200 for a total of 4. So 1,000 minus 4, because 200 each year, 1,000 minus 4 is 600. That's the actual cash value of the item. So you take the current replacement minus the depreciation. So if they say it's $200 a year and it's been 3 years, you have to go 200 plus 200 plus 200 is 600. So 1,000 minus 600 would be 400. Okay. I don't care about the original price, but actual cash value is replacement minus wear and tear, replacement minus depreciation equals actual cash value. And these are the two they talk about the most. Oops. Replacement. Oh my God, how do I undo that? Where's my undo button? There we go. Actual cash value and replacement are the two they ask about the most. I'm going to mention these other ones, but they're not tested on nearly as much. Market value is what a willing buyer would pay a willing seller. Market value, when you think of a house, when you go to buy a house and you get a mortgage on that house, you're getting the house, you're getting the land, you're getting the neighborhood, you're getting the popularity. That's what you're getting when you buy a house. That is the market value of the house. What a willing buyer would pay a willing seller is the market value. That has nothing to do with replacement. Replacement to the insurance company is how much would it cost to rebuild this house? How much money would I need to rebuild this house? That's replacement, which may or may not be how much it costs to buy this entire property. Because when I buy a house, I get the house and the land and the neighborhood and the popularity of the neighborhood, the location, right? I had a guy, he was, oh, that's a dog. When I was selling insurance, a guy called in. He said, I just bought my first house. I want to get it insured. I'm so excited. It's in a very cool neighborhood. Everyone wants to live here. I finally got a house here. And I said, cool. It was like near the beach in California. I said, tell me about the house. 1 bedroom, 1 bathroom, tiny little thing. And he's like, I paid $500,000 for it. And I'm like, cool. I'm going to insure it for $100,000. He's like, but I paid $5,000. I was like, you paid for that neighborhood. You paid for that piece of land in that neighborhood. The structure itself, tiny, only need $100,000 to rebuild it. And the insurance company only cares about the structure, not the land, not the popularity of the neighborhood. Market value includes the neighborhood and the popularity and the land. Insurance only cares about the actual structure. So market value is not something that insurance companies really care about until market value is less than rebuilt, which is pretty rare. If you're buying a house and land and in a certain location, usually that should add up to be more than the structure itself. But when you can get a house on a piece of land for less money than what it would be to build just the house itself, insurance companies go, we don't like that. We don't like that you could buy an entire house and a piece of land for less than what it would be for us to have to rebuild that structure. And with policies like that, they give them an HO8. HO8 policies are for like older houses or where the market value is less than rebuilt. Imagine, because if you buy a house, and this is true, like especially in Michigan has this problem a lot. The house values are so low in Michigan that you could buy a house for way cheaper than what it would be to build that structure brand new. So my cousin, for instance, he got like a 3-bedroom house for like $15,000. Yes, it was in a neighborhood, and yes, it had some like a scary neighborhood, and yes, it needed some repairs and stuff. I'm not saying it was a nice, fresh house, but he got a whole dang house and a whole piece of land for $15,000. He would want it to burn up so that the insurance would rebuild them a new one, right? Like you'd almost want it to happen. And so insurance companies are like, we don't want that to happen. So they limit the amount of coverage that a house has. They limit the perils and the coverages when a house has low market value, but high rebuild. But anyway, that's the one thing they talk about with market value, and that's on an HO8. We'll get more into an HO8 here later. Now, functional replacement also goes along with an HO8, actually. Functional replacement is the modern, less expensive price to make repairs. So if a house is built with plaster, now plaster used to be the way they made walls, lath and plaster. They would get like boards of, they would take wood, and then you kind of like throw cement on it and like smear it around. It's not cement, it's plaster, but same kind of concept where it's like wet and you put it on there and then it hardens. That's lath and plaster. We no longer make walls like that. That's how we used to make walls before drywall existed. That's why it's called drywall. It's not wet. Lath and plaster is wet. It's wet and then it hardens. Drywall is just a piece of board that you go ding, 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 nail it up, boom, there you have a wall. Functional replacement says, if you have a house with plaster and it burns, we're going to use drywall to rebuild it. We're not going to use plaster. It's cheap, or it's more expensive and it's outdated. We don't use it anymore. So you may have a house, an HO8, that has plaster, and if the kitchen burns down, when they come in to rebuild it, they will not use plaster. They will use drywall, which is the modern, less expensive material. Okay. So functional replacement is typically used on an HO8, where the HO8 is an older house, not been updated. All right, now this is not so much for a house, but these go along with loss valuation, because when you get a policy, you can either get agreed or stated. Now, this is going to come from an idea of, let's think about a car, and let's say this car is like a collector's car. Let's say it was the DeLorean from the movie. I almost said Land Before Time, but that's the wrong one. Back to the Future. Thank you. The DeLorean from Back to the Future. And it's like, you can't value that based on just the car itself. It's got all this other value because it was in the movie, and it's got this memory, and it's got this whole cult following to it. Okay. So that car is going to be very valuable. Let's say that somehow your rich uncle had it, he died, and he gave it to you. Okay. You are now inheriting this extremely valuable car. When you go to insure it, the insurance company is going to say, okay, we've got two types of policies for you. One will be cheaper, one will be more expensive, which kind of makes the difference between why you would choose one or the other. And the reason one is more expensive than the other is because how they will cover it. You come to them with this collector's item. It's hard to put a value on that because, again, the value is based on people's desire for it, not so much the actual car itself. Okay. So it can be hard to value something like that. You pick one of two options. An agreed value policy is where you and the insurance company agree on a set value. And if the car is destroyed, you will get exactly that value that you agreed upon. So you and the insurance company did a fair valuation. A fair valuation means you evaluated it, I evaluated it. We agree that the valuation of this car is $1 million. And they will pay you $1 million if that car is destroyed. No question asked. Boom, here's $1 million. That's an agreed value policy. You agree on the amount. Any claim happens, you get that amount. It's an agreed value based on a fair valuation. And fair valuation means you agree, I agree, we agree that this is what it should be covered for. And they will pay you exactly $1 million. Now that policy is going to be more expensive than a stated, because a stated says we will pay you up to $1 million. But we're going to check and see the market to see if that kind of car with that kind of, cult following is selling for that much. And if people are not as interested in it anymore, it might not be as valuable. We will pay you up to $1 million, but we may pay you less if the current price for that car is less. So agreed says we agree on exactly this value after a fair valuation, and we will pay you exactly this value if the item is destroyed. Stated said we will pay you up to this value. And it is the max that you can get, the maximum. You may get less, but this is the max. So stated will be a little bit cheaper because they might not pay you the full $1 million. The key words for agreed is fair valuation. You know they're talking about an agreed policy when you see the words fair valuation in the question. The insurance company and the insured were trying to figure out the fair valuation for their policy. What type of policy is this? Agreed, because they use the phrase fair valuation. In fact, we can bold that, fair valuation. And then, where's my bold? There it is. And then with stated, the keyword is maximum. They focus on maximum with stated because stated is stating the max. It's stating the max that's available. You can get less than that, but they're stating the max value. Okay. All right. Now, when we go to get our homeowner's policy, there are we need to understand the different types of damages that can happen to the house. Now, these are coming more from the casualty side. And what I mean about the casualty side is property. When you read the chapter types of property or you're learning property policies, their focus is on me and my stuff, my house, my furniture, my belongings. A property policy is about me and my stuff. A casualty policy, on the other hand, is about other people and other people's stuff. Your car, your house, your things, your body. Damages tend to be more of a casualty thing because you're generally responsible for the damages you cause to other people. So when you're doing a property and casualty exam, they may separate basics of property from basics of casualty. Damages are usually in the basics of casualty section. Okay, just wanted to kind of point that out. Now you just need to know these definitions. Property damage is direct damage to the property. That's what you're covering your house for, is property damage. If a fire happens, it damages the property. I need you to rebuild it. Property damage is the main thing that we're covering on our policy. Now, on the flip side, property damage is also the other guy's car. Like if I crash into you with my car and I have damaged your car, that's also property damage. Property damage is just any direct damage to the property, whether it's mine or yours. Property damage is damage to the property. Okay. Bodily injury is direct damage to a body. It's got to be to the body. Okay. So bodily injury is hurting my body gets hurt. So if I crash my car into you and the car accident breaks your leg, that is bodily injury. Okay. Bodily injury is direct damage to your body. Now, when they pay out money to your body because of your body, there are two things that you can get. You can get special damage and you can get general damage. And they are quite literally the opposite of what you would assume. We would say, oh, you're in an accident, there's damage to your body. Medical bill makes a lot of sense. That should be a regular damage that is covered, but they don't call it general, they call it special. It's very weird. When you think special damages, you want to think dollar sign. In fact, I usually turn this S into a dollar sign. Special damages is when there is a medical bill, like there is a bill, you can add it up. You say, oh, she went to this hospital, this chiropractor following the accident. The hospital cost this much. The chiropractor cost this much. This is exactly as much money that we caused to her body. And we're going to pay that out. So special damages are the damages that actually have a bill, a dollar sign. We can count it. We can add it. We can see exactly. Even if you had a car accident, like if I crash into you and you're damaged, you go to the hospital, you're missing work. The hours that you're missing at work, we can calculate and add them up, and I might have to pay you for that because that's an indirect loss. Losing money on work because of a car accident is an indirect loss. And because I hit you, I am responsible for that. I can be held responsible for that. So special damages are medical bills or loss of wages after an accident. But we can add up medical bills. We can see a list. We can see a statement. We can get a bill. Loss of wages, we can add it up. You make this much money for this many hours. You miss this much hours, so you miss this much money. Easily calculable. Easily calculable. Special damages are easily calculable because we have a bill. We have a statement. General, on the other hand, it's all subjective. Well, what do you feel? General is all about feelings. It's pain and suffering. It's mental anguish. Well, I was in a car accident and you made me fear for my life, and now I have PTSD and you owe me millions of dollars. That's general damages, which again seems the opposite. You would think general is the medical bill and the lost wages, but no, they call that special. Special is the medical bills. General is what a judge and jury feels is right. So when you get general damages, that usually means you've probably gone to court. You've probably sued that person for pain and mental anguish. Not to say you have to go to court. So insurance companies will generally offer you, hey, for your pain and suffering, here's some money on top of your medical bills. But if you're getting a lot of it, you probably sued them. But like, if you were in a car accident with Justin Bieber, if Justin Bieber was going on a crazy joyride and crash into you, you're going to ask for millions and bajillions. The pain and suffering from Justin Bieber hitting me is awful. It makes you sue happy when someone with a lot of money hits you, because it's subjective. It's whatever they agree upon. So general is what a judge and jury feels is right. They're going to award you these damages. You were in a car accident. Justin Bieber hit you. I have so much pain and mental anguish. Okay, here's money to make it feel better. That's what general damages are. It's the pain and suffering, the mental anguish, which is very subjective. And they will ask you which one is subjective. General, not special, general. So just remind yourself it's the opposite of what you think. What, baby? You got that one wrong? He failed all 4 exams, which is why he reached out to me. Okay. Anyway, he's no longer trying to test because now he works for me anyway. So. All right. So, and then there's also punitive, which I didn't put in here, but punitive is for punishment. Punitive is punishment, which would be like if Justin Bieber did go on a joyride, not only would he have to pay the damages of the buildings that he's destroyed and the bodily injury of anybody that he's hurt, the judge would probably punish him and say, you have to pay an extra $2 million for taking this joyride. So it is punitive is for punishment. And it's attempts to try to make you never want to do it again. Okay. It's not tied directly to an actual bill or mental anguish. It's just punishment to try and get you to never do it again. Okay. Now, so those are the damages. You have bodily injury, which is damage to your body, property damage, which is damage to property. And then when they pay out the damages for you that happened to you, you get special damages, which are your actual medical bill, your actual loss in wages, or you get general, which is pain and suffering, what a judge jury feels is right. And I say general judge jury feels is right. very subjective. It's based on feelings. Like, think about this for a second. If you are married and you hate your spouse and you get into a car accident and they die, you might be happy. Like, oh my God, thank God. What's that one song, that country song where he like gets a lottery ticket after his wife breaks up with him or something? And he's like, thank God I got all this money without you. Bye. Or if you have a couple and they are madly in love with each other and their spouse dies in an accident, they might be like, oh my God, you took my whole life away. It's very subjective. It's based on feelings. Okay. So that's what we mean by subjective. It's feelings based. And it ultimately is what a judge or jury feels is right to award you with those damages. Okay. Now, absolute liability, strict liability, vicarious liability. Homeowners also covers what is called liability. So we talked about how homeowners will rebuild your house if your house burns down. Okay. That's property damage. Rebuild your house if the house burns down. Then some of the coverages on the homeowners is the liability. Now, liability says I am responsible for doing something. So if I am liable, I am responsible for what happened. If I have a dog and my dog bites you, I am liable to you. I am responsible to you because my dog bit you. My homeowners has coverage for that called liability. I have liability coverage, which will pay out to you for the damage that my dog caused. Okay. Now there's different types of liability. On homeowners, you just call it liability, but you need to know a few different types of liability. These will only show up as definitions. You don't need to be, well, is homeowners absolute or strict? You don't need to know that. This is just, as an insurance agent, you just need to understand some different types of liability. They will only ask you these as a definition question. The first type is absolute liability. And absolute liability says that you are absolutely guilty. You are absolutely at fault. I want to check our time, see where our time is at. I think we're going to 2:30, right? Yes, 3:30. Okay. So, and it's okay. Okay. What time is it? It would be almost 2 now. No, almost 3 now. Okay. Got it. All right. No worries. All right. So absolute liability is absolutely obviously dangerous. This is Joe Exotic, literally Joe Exotic, swimming pools and a pet tiger and explosives. Those are the things that make you absolutely liable. When you are doing something so obviously dangerous, so obviously hazardous, that is absolute liability. We don't need to prove it. We don't need to be like, well, they were doing this extremely no, you were doing this extremely dangerous thing. You are absolutely at fault, absolutely guilty. Okay. We don't have to prove it with absolute liability. So if I have a dog and it bites you, I'm guilty. End of story. Doesn't matter if you antagonize my dog. I have the dog bit you, period. I have a swimming pool. The swimming pool is dangerous. You dig a hole out of the ground, fill it with water. Humans can fall into it and drown. Dangerous. So if you have a swimming pool, you are absolutely liable. So pet tigers, and the exam literally has questions with pet tigers. Pet tigers and swimming pools make you absolutely liable. What you were doing was so dangerous, we don't have to prove it. All right, strict liability. Strict liability is about a product. So if I have a cell phone that I buy from you, or let's say you're a manufacturing company, okay? And I buy a cell phone from you and it explodes in my hand, that's strict liability. Strict liability is strictly product. It's about the product. And if the product causes damage to the person who bought it, strict liability. They usually bring this one up about tires. So on the state exam, they'll say the tire company made tires that were faulty. What type of liability is this? Strict liability. People will confuse absolute and strict because absolute says you don't need to prove fault and strict says fault doesn't matter. And so you kind of confuse the two. That's why I wrote it in the way that I did. Absolute is obviously dangerous, swimming pools and pet tigers. Strict is strictly products. When they say strict, there has to be a product. There has to be a tire that was produced, a cell phone that was produced, a microwave. There has to be a product that they're talking about if the answer is strict liability. But if they say you were behaving dangerously, it's absolute. There's no product involved. It's just you just behaving dangerously or having a tiger or something. I pulled a cord and that got scary. I was like, oh my God, I was going to unplug, but I'm fine. Okay. Now, vicarious liability is actually comes from Old English law, and they may even use the phrase Old English law on your state exam. They'll say what type of liability follows Old English law, and it is vicarious. So this came around at the time back when we were run under kings and queens, and the king would own a kingdom and he would have knights that would protect the people in the kingdom, and all the little plebeians, the village people would, grow the crops and they would give the crops to the king and the king would protect them. And the king had what was called vicarious liability, that he was responsible for all the townspeople and their wellness and their protection in exchange for being the king. So the parent nowadays, instead of the master is responsible for the acts of the servant, that's what vicarious liability came from. The master is responsible for the acts of the servant. Nowadays, it's the parent is responsible for the child and the employer is responsible for the employee. So that is how they talk about vicarious liability. Oh, I missed some of your guys' chat box. I just pulled that up. The vicarious is saying that the employer is responsible for the employee. Whatever the employee, like even just vicarious, like who has the most money, who is more likely to pay. So if a child goes into a museum and breaks all the stuff, the child don't have money, the parent does. The parent is responsible for what the child does, so the parent wouldn't need to pay. So vicarious liability says the parent is responsible for their child, the employer is responsible for their employee. Okay. And then, so sorry to keep up with the chat box. Rhonda said, can you put the PNC basics in the chat box as well? I did that. So that's your notes document. If you're watching the recording, check somewhere down below will be a link for the notes. And then Yesenia said, so every time I see general damage, they were referring to pain and suffering. Yes. Generally, I am suffering. Generally, I'm in pain. Maybe that's one way to think about it. Generally, we're all suffering. So general is pain and suffering. General is pain and suffering. The general causes pain and suffering. The judge and jury decide what is right. Okay. All right. Yes. Okay. Thinking, policy structure, common policy provisions. Trying to think about where I want to move to. Yes. Okay. Okay. Now we're going to talk about buying a policy, buying the homeowner's policy so that you can get all of this coverage. Okay. The first thing when you have a policy, you are the name insured. So the name insured is the person who actually bought the policy. The name insured is the person who called the insurance company, told them the details about the home, and bought the policy. That's the name insured. The first named insured is specific only to commercial insurance. First named insured is specific only to commercial insurance. Commercial insurance is about a business. Multiple people can own a business. No one can own like the company itself owns a business. Like it's not one specific person. It could be an entity on its own. So when a company buys a business, or I'm sorry, when a company buys an insurance policy, they're stop. Babe, he's throwing up. No, it's on the fucking carpet. Oh my God.
Outside. Outside.
Oh my God. That was scary. I heard the sorry. That made me hot and flustered. Okay, I caught the vomit. We're good. What were we talking about? That got scary. This is not our house. This is an Airbnb house. I don't want to ruin their carpet. Talk about lie. I would be absolutely liable for that. Okay. I literally caught it all on my lunch plate. Mostly it looked like it was just grass. So that's good. But anyway, okay. He just walks over here.
He was just outside though.
At least I got the warning gurgles.
Only us. Really?
Bloopers. Yeah, I'm gonna take that snippet out as a blooper. Okay. Anyway. Okay. Commercial. There's many people that can own a business. There needs to be somebody at the business that the insurance company can talk to about the policy. And that's going to be the first named insured. So the first named insured is simply a designated person that the insurance company can talk to about the coverage at that business. So think for an oh baby, it's okay. Yeah, that's fine. It's a little bit. There's a little one. He did not throw. The big one threw up. The big one threw up vomit this size. Anyway, I couldn't. That's why I couldn't move him. He was so big. I was trying to get him to the wood flooring, but I couldn't. So I just put the plate under his mouth and then kept moving the plate to follow his mouth. Okay.
You don't need a break.
We're okay.
Are you sure?
I'm sure.
Okay.
Okay. So there needs to be a designated person at the business. Imagine, for instance, you work at an insurance agency and they've got an office building and they're insuring that office building. So, right, everyone needs insurance. So even if you are an insurance agency, you have insurance on your building. Okay. Let's say you work at that building and the building is insured by Allstate, and Allstate calls one day and says, hey, I need to talk about the policy on the building, and you work there, so you know about it, right? I can talk to you about the coverage on the building. Be like, I don't know about that. I'm just an agent. I'm not the one who owns this building. I'm not the designated person. There needs to be a designated person. They can't just call anybody at the business and talk to anybody at the business. They need to have a designated person who's allowed to make decisions about the policy, and that's the first name insured. Now, what's really cool is that the first name insured is always that question, it gives itself away because they will say, who is named first on the policy? First name insured. It's that simple. Whose name appears first on the declaration page? First name insured. If they use the word first in the question, the answer will be first name insured. That one's easy peasy. They give that one away. Now, insured is one that kind of confuses people a lot. And insured, because insured doesn't mean name insured. Name insured is the person who actually bought the insurance, the person whose policy it is. If I buy my homeowners, it is my policy. I am the name insured. If my dog bites you, you're a random stranger walking along and my dog bites you, you are an insured now on my policy because I owe you money. I am liable to you. Anybody who is covered by the policy is an insured. Now, you're not an insured until my dog bites you. You're not named on the policy nor will you be named on the policy even after my dog bites you. Insured simply means I can collect money under that policy. So an insured is anyone who is covered by the policy. So if I have a car insurance and I crash into you, then you're an insured on that policy, and I will pay you money, and or my insurance will pay you money. You're an insured. So an insured is anyone who is covered. Anyone who is able to collect money off of a policy is an insured. Name insureds are the people who bought it and are actually listed on the declaration page, which we haven't talked about yet, but they're the ones on the actual declaration page. Now, an additional insured is somebody who has interest in the property. So when if I buy a house and I'm covering the house on a homeowner's policy, I probably have a mortgage. Most people have a mortgage, and a mortgage says, I don't have all the money to buy a house, but I want to make payments to buy a house. That's what a mortgage is, making payments towards owning a house. And you get a mortgage through the bank. So you go to the bank, you say, hey, bank, I want to get a house. I want you, bank, to buy this house for me, and I will slowly make payments on it so that it becomes my house and it's paid off. That's what a mortgage is. So when a mortgage company, when a bank buys the house for you using a loan, and you're making payments to them, while you are making payments to them, they have interest in the house. They have insurable interest in the house because they're the ones who actually put up the money for the house. And if you, as the borrower, decide to quit paying or walk away from the mortgage, the bank owns the house. So they have insurable interest in the house. If you own a house and it burns, and you have a mortgage and it burns down, and you decide not to rebuild, and you cash that money out, and the mortgage gets nothing, they're like, They want to be on the policy to make sure that they will get the money. So when you have a mortgage, when you have a bank that you are making payments to for a house, that bank is going to say, I need to be on your insurance. I need to be added to your policy so that if the house is destroyed, we will get our money to pay off this mortgage. So mortgage companies are added to the policy as additional insureds. So mortgage holder, lien holder, they're added to the policy via endorsement. Okay, they're added to the policy via endorsement. Now this is, so they're not named, they're not on the front page. They are actually stapled to the back of the policy. Now we haven't gone into the definition of endorsement yet, but endorsement is when you, an endorsement is a written change, a written addendum. An endorsement changes what was typed up. So remember we talked about aleatory adhesion, where what the insurer says is what needs to be, covered. They have to stick to what they said. When they type something, and when insurance company makes a form, when they make a policy that can be sold, they have to get it approved through the Department of Insurance. They don't want to have to go through that process a lot. So what they do whenever they want to make changes is they just create an endorsement. And an endorsement, when stapled to the back of the policy, it makes a change to whatever is typed here. So for instance, if it's typed here that says, we will not cover water sewer backup, this is excluded. But then you take an endorsement which says we cover water sewer backup, and you staple it to the policy. Now the policy covers water sewer backup. You added a change to the policy and you stapled it to it. That's an endorsement, is a written change. Not every endorsement or written change does cost money, but the water sewer backup one would. Endorsements are printed written changes, printed addendums, written changes. That's how they talk about it. And it could either be, adding the mortgage company, which isn't going to cost you money. It does not cost you any money to put on your policy that you have a mortgage with the bank. You're just letting them know, and then the bank then has their share in the insurance. But if you're adding a coverage like water sewer backup, that endorsement would cost money. So some endorsements cost money, some don't. Most of the time on the exam, when they ask about endorsements, most of them will imply that it's going to cause a premium increase, because a lot of endorsements are extra coverages. While some endorsements are adding an additional insured or fixing the spelling of your name, other endorsements, most endorsements they talk about are adding extra coverages. You can get an earthquake endorsement. You can get a water sewer backup endorsement. You can get a credit card fraud endorsement. None of these things are covered by your homeowners by itself. But if you add these endorsements, then they would cover the homeowner's policy. Okay. They would now be covered on the homeowners. So anyway, back to an additional insured. They are added via endorsement. So that means that they added to the policy that this mortgage company is also covered by your insurance because they have a specific interest. Remember, interest means you own it. Blood, business, or money. Interest means I own it. A mortgage company owns the house, and as you make payments, that ownership is shifting. But while they still have any stake of ownership in it, they want to be covered by your policy as well. Okay, so they get added to the policy in regard to a specific interest. And that specific interest is however much money they are owed. So if I have a house and it's for $100,000, let's say it's $100,000 total. The house itself is covered for $100,000 and I have a $50,000 mortgage. If that house burns down and I decide not to rebuild, my insurance company is going to go to my policy. They're going to flip to the back and they say, does she have a mortgage company listed? Yes, she does. They're going to call that mortgage company and they're going to say, hey, Melissa's house burns down. You're listed as a mortgage company. Are you owed any money? They say, yes, she has a $50,000 mortgage. The insurance company will send them $50,000 and send me the rest. Because the mortgage is added in regard to their specific interest, which is however much money is left on the loan, however much money is on the mortgage. And if the whole house burns down, generally the insurance will rebuild it. Your mortgage stays intact. But if you decide I'm not going to rebuild, you don't have to rebuild, by the way. You can just take the check and run. There's no rules that say you have to rebuild the house. If it's completely destroyed, say, you know what, I just want the value for it. I'm going to go rebuild somewhere else. You can do that. But if you have a mortgage on it, the mortgage needs to be paid off first. So the insurance company will call the mortgage company that's listed as an additional insured and say, are you owed any money? And if they are, they will give them money. Now, if they are not, they will not be given money. So sometimes on the exam, you will get these questions that say, you had a mortgage with ABC Bank. You added ABC Bank to your policy when you first got it. You have since paid off your mortgage, but you forgot to tell the insurance company to remove ABC Bank off of the policy. What will happen when you file a claim and they pay out the value of the house? The answer is that the mortgage isn't going to get anything because they're not owed anything. So what will happen is the insurance company will call ABC Bank and say, hey, we see you here listed on Melissa's insurance policy as the mortgage. Are you owed any money? No, we're not. She paid it off a few years ago. Great, thanks, bye. And then they'll send me all of the money. They only pay the mortgage if the mortgage is owed money. If you accidentally forget to remove a mortgage company off of your insurance, if the mortgage company is still stapled on the back of your policy as an additional insured, it's okay if a claim is filed and they're still listed, because the insurer will just call them, and if they're not owed money, they won't get any. It's not a big deal. The way they frame the question makes it seem like it's a big deal, like, oh my God, the mortgage is going to get the money and you won't. No, if they're not owed money, they won't get money. Okay, now when you buy a house and or when you buy your policy, you're going to be given, your policy is going to come, policy structure. So when you buy your homeowner's policy, it's going to come in parts. Okay. Every policy has different parts to it. Like, even just a contract, any contract has different parts. This part explains this, and this part is this. So policy structure is just saying these are the parts of a policy. So policy structure saying these are the parts. Think of it as like a table of contents. When you think of a table of contents, you have, okay, they're like, this is a book on insurance. Study this book for insurance. Chapter 1 is general insurance terms. That's one part. Chapter 2 is policy provisions. That's a second part. So when we think of policy structure, we're just talking about parts of a policy, okay? Parts of a policy. The first part of a policy is the declaration page. That's where they're going to put the name insured. So you call the insurance, I am the name insured, I'm buying this insurance. They are going to put you on the declaration page. We are declaring that Melissa is covered for this homeowners. The declaration is declaring who and what and where and the coverage is. So a declaration declares who the name insured is, who the company is, how much coverage you have, and for what structure, at what address, or what car. So the declaration page is kind of like a summary of the policy of who and what is covered and by what company and what amount. An acronym, you don't need to remember this necessarily, but I'm putting it in a chat box. Oh, I did too many. NNAAPP. NAP. The declaration page, again, it's not important to remember this. If you remember the who, the what, the where, if you understand the deck page is a summary of everybody, that's fine. If you need more clarification, they don't specifically ask about NAP necessarily, but if you know the declaration has NAP, you can answer the questions on the declaration. So after an insurance class, any other insurance class taught about insurance other than the Queen makes me want to take a nap. This class is so boring. How many of you have teachers who just read from the book? Oh, I want to take a nap. No one is as exciting as me with their dog throwing up in the background, right? Anyway, nap. These insurance classes want to make me take a nap. And name of the insured. So that's your first N, name of the insured. Name of the insurer, NN, nap. Then you have A, address. Where is the house located? Amount of money. So we have name of the insured, name of the insurer, address, amount of money. P for property description. What is this property? 3-bedroom, 2-bathroom house, 2009 Toyota, whatever the property description is. And then premium. So that's the summary of what is on a declaration page. And that's NNAAPP, nap. I want to take a nap after this insurance class because it's so boring. Okay. Name of the insured, name of the insurer, amount of money, address, property description, premium. That's what's on the deck page. And that's the first page. Okay. Then you're going to have the definitions. The definitions is just the next page of the policy that tells a definition of the words they use. Like on car insurance, they like to use you and your a lot, and you and your is you and your spouse. So on the car insurance policy, that when we refer to you, we are referring to the name insured and spouse. It's just defining what you means on the insurance policy. So because it's a big, wordy, legal document and contract, they want to make sure that we're clarified on what some of these things mean, and that's just the definitions. Now, we can confuse declarations and definitions because they may say, where do we go to find the name insured? Or how do we know what the name insured is? You got to be careful. Are they asking if they're asking who the name insured is, we would need to go to the deck page to see the actual name. So who is the name insured? We would need to go to the deck page. If they say what is the name insured, we would need to go to definitions to find out what the name insured means. What does that mean? Okay. All right. The next part of the policy is known as the insuring agreement. The insuring agreement. This is what I would like to say is the essence of the policy. This is what says, if your house burns down, we will rebuild it. If hail breaks your window, we will replace it. If a dog bites your neighbor, we will pay the medical bills. This is the part of the policy that actually describes what is covered. Your declaration will only declare how much money is available, but the insuring agreement is what actually says what's actually covered if something actually happens. So the insuring agreement is what will list the perils. Remember, the perils are the cause of loss, the reason that I'm filing a claim. So the perils would be fire, lightning, wind, hail. My declaration page will not declare the perils. I would need to go to the insuring agreement to find out exactly what perils are covered. The insuring agreement lists the perils insured against. The phrase insured against is a little weird. Insured against means covered for. If you are insured against something, you are covered for it. So if you're insured against something, you are covered for it. So the insuring agreement lists the perils insured against. Like you're insured against fire, meaning if fire happens, they will cover the fire. They will pay for the damage after the fire. So the insuring agreement lists the perils. It also has a few other P's. It also has the promise. We promise that if this peril happens, we will pay the claim. So a peril is a promise to pay. We promise to pay if this peril happens. So insuring agreement lists the perils. Then it also lists the parties. We promise to pay Melissa if this peril happens. Melissa is the party. I'm the homeowner. I'm the party. The insurance company is also a party. Remember, insuring agreement is the parties. Or sorry, but the agreement, insuring agreement, think about the word agreement. Remember, agreement, offer and acceptance, the two parties, insured and insurer, the two parties come together in agreement. So the parties are just the people involved. Insurance company, insured, okay, customer, company, customer. These are the parties. So the insuring agreement will say, this insurance company will cover this person if any of these perils were to happen, we promise to pay. That's what the insuring agreement is. It also lists out the period, how long it's good for. The one thing that's not in the insuring agreement with a P is premium. Premium will stay on the deck page. Oh, sorry, up here. Premium stays on the deck page, not in the insuring agreement. It's the one P that's missing. So the insuring agreement has the parties, it has the perils, it has the promise, it has the period, but not the premium. Okay, so we buy our policy and we tell the insurance company, so we say we have a home, we have the risk of it burning down. If there's a fire, we want to know that you will rebuild it. So they say, yes, we are going to insure you. They're going to do all the underwriting, ask you questions about the home, what kind of countertops, what kind of roofing, what kind of siding. They're going to figure out the premium based on that. And then they hand you the policy structure. You begin to read it. The declaration page says, we're covering your house for this amount of money. This is where you live. This is the type 3-bedroom, 2-bathroom house. Here's how much money is available for the coverages. You flip the page over. Here's the definitions. This is what you and your means. This is what insured means. Cool, flip the page. This is the insuring agreement. This is the part that tells you we promise to pay if this peril happens. We promise to pay if this peril happens. We, as the insuring party, will cover the insured. You're the party, we're the party. Here's all the promises. Here's all the perils. That's the insuring agreement. The insuring agreement also lists the actual coverages to the policy. So we're going to talk about this in a minute. But on a homeowner's policies, there are main coverages, which will go under the insuring agreement and the declaration page. And then there are what I like to call side dish coverages. So on a homeowner's or a dwelling, and even an auto, and even a commercial, coverages are listed as A, B, C, D. They're alphabet. You know it's a main coverage if it's got an alphabet number. If it's got an A, a B, a C, or a D, or an E, or an F, it is a main coverage. Any coverage that doesn't have an alphabet is additional or supplementary. So you have major, you can think of them as major and minor. You could think of main dish, side dish, but major coverages are the ones that have an alphabet, A, B, C, D, coverage A, coverage B, coverage D, part A, part B, part D, but they got the theme is A, B, C, D. If it doesn't have an A, B, C, D, if it just has a name like lawn, trees, shrubs, and plants, it is known as additional. So after the insuring agreement, because the insuring agreement will say coverage A, you are covered if this happens, this happens, this happens. We promise that if this peril happens, we will cover this. So all the major coverages will be under the insuring agreement. And then the next section of the policy will list out extra or there are additional coverages. But the key thing about understanding additional coverages is that it's not additional money and you're not adding them extra. They are automatic. They are built in. You can't remove them. You can't take them off. Okay. So one of the additional coverages, for instance, on a homeowner's is lawn, trees, shrubs, and plants. Lawn, trees, shrubs, and plants. Whether you have a house with or without a lawn or trees or shrubs or plants, your policy will come with lawn, trees, shrubs, or plants. Okay. You get it no matter what, whether you need it or not. It's built in, it's automatic. You can't remove it. And it's not costing you extra money. It's built into the cost. So you can't take it off. I kind of like to think of it when you go to a restaurant and you order a meal, you're paying for the meal, but not the plate. The plate is included with the price of the meal. You know, like you're not paying rent for that plate. It's part of you receiving that meal. Additional or supplementary is part of getting the meal. Or like, you know, you go to Texas Roadhouse, you buy a steak dinner, it automatically comes with 2 side dishes, whether you want them or not. They're going to charge you the same price for the steak dinner, whether you actually decide to take the cover, whether you actually decide to have the salad and the baked potato, doesn't matter. They're going to charge you the same price. So you take the side dishes, you might as well. So additional or supplementary is not extra cost. It doesn't change the price to not get the baked potato at Texas Roadhouse. They're going to charge you the same price no matter what. So that's what additional or supplementary is. It's automatically on the policy at no extra cost. So additional or supplementary is extra coverage at no extra cost. And when I say extra, it's just not A, B, C, D. It's beyond A, B, C, D. It's more than the A, B, C, D. But when you look at your premium, they break it down by coverage A, coverage B, coverage C. You can see they may say total premium is $1,000, but they'll be like coverage A is 600, coverage B is 200, coverage C is 300. Like each coverage will have its own amount of money. When you look at additional or supplementary, there's no dollar amount listed next to it because it's automatic and built in. Now, another thing with additional or supplementary is that whatever it is they do cover, what they cover is extra money in addition to what we say. So let me clarify that. Coverage E on a homeowner's, which again, we're going to have a whole chart where understanding coverage A, coverage B makes a lot more sense. But coverage E on a homeowner's is known as liability. This is a coverage if my doggy bites you, liability, I owe you money, my doggy bites you, liability. I'm responsible for my doggy that bites you, coverage E, doggy. The money that I have available to pay your bodily injuries is whatever coverage E is listed at, like $100,000. So if my dog bites you, my coverage E will pay out to you. If my coverage E is 100,000, you could get all 100,000. If your injuries, are that bad, you could get all 100,000. I have more money on top of that to pay for a lawyer if you decide to sue me. Like if you say, you know what, 100,000 isn't enough. I want $1 million mental anguish. I'm going to sue you to try to get the rest. I'm going to sue you to get more money. My insurance company, as part of my coverage E liability, has money for a lawyer. They have money to defend me. And they have to defend me whether it's frivolous or not. So part of the responsibility of the insurance company is to defend me. The money for the lawyer is in addition to the money of what paid out to you. So my 100,000, my doggy bites you, my coverage E is at 100,000. All that money is for you. You can get up to that amount of money for your injuries because that's my limit. If you want to sue me to try to get more, my insurance company can provide me, and not even if you just sue me in general to even get the 100,000. If you sue me in any form or fashion because of a dog bite or something, or you made something up, my insurance provides me with a lawyer, and they will pay for the lawyer until the money for the lawyer is gone. Their duty to defend me ends when the money runs out. So the duty to defend the person will stop when the money runs out, yes. But the money to defend me, the money for the lawyer, is in addition to coverage E. And this is where a lot of people struggle with questions on the exam, because they'll say, is this money in addition to or not? Yes, the money for the lawyer is in addition to the liability limit of coverage E. It is extra on top. So most additional and supplementary coverages, most of the money available, even the lawn, trees, shrubs, and plants, a lot of the money that you get for that is in addition. So it means you get extra. When they say it's in addition, you get this money plus this money. So I get $100,000 to pay out for your medical bills from the dog bite, and I get money for the lawyer. It's in addition. Okay, so additional or supplementary is going to list out all the built-in extra coverages at no additional cost. Built-in extra coverage to all the policies at no additional cost. Okay, now conditions. So again, you're looking at your policy, you look at the declaration page, it declares you are the insured by this insurance company, you have this much money for your coverages, you're at this location, here's a brief description of the house, you flip the page, definitions, you and your means this, cool, flip the page, insuring agreement, here's how we coverage A, coverage B, here's the perils that we all promised to pay for, flip that. Additional coverages, here are the extra coverages that you get at no additional cost, cool, flip that. This page is now the rules, the duties, the obligations, the ways of behaving. We kind of already talked about conditions, how it's, I have to do this, you have to do that. We both have to follow these rules or the policy doesn't work. Here are your rules, here are my rules, follow the rules. These are the conditions. So there's a whole part of the policy. As I'm reading my policy documents, there's a whole part of the document specific to the rules that we have to follow. And that's conditions. So conditions are the rules, duties, obligations, ways of behaving. When I say ways of behaving, what I'm saying is they can ask you a question that says, what must the insured do after an accident? Or how will the insured know what to do after an accident? How should the insured behave after an accident? Well, let's look at the conditions. They have to call the insurance company within this amount of time. They need to get a statement of what's missing. They need to cooperate. They need to communicate. They need to get a 911 if it's a hit and run. Like the conditions are how to behave after an accident, how to cooperate with the insurance company, how to blah, blah, blah. Conditions are the rules, duties, obligations, and ways of behaving as part of the policy. Okay. Exclusions, like we've talked about, are the things that are not covered. Exclusions are what is not covered in the policy. Earth movement and water damage are the only two that you really need to focus on memorizing. As you read through all of the material, you're going to read exclusion after exclusion after exclusion, big old long list of exclusions. You don't need to know all of them. Earth movement and water damage are the two main exclusions. They are not covered on the policy. Earth movement would need an endorsement. Water damage, you would need a water sewer backup endorsement and a flood policy in order for that to be covered, okay? Those are the only two exclusions you need to worry about. Endorsements, we talked about endorsements being when we were talking about additional insureds, wherever that went, additional insureds, we were saying that they were added via endorsement. This is the part of the policy that would have that. This is the part of the policy. So it'd say so remember, you have the policy and the endorsements are stapled to the back. Every endorsement you get gets stapled. It gets added to the back. It becomes part of the policy. An endorsement is a written change, a printed addendum. Those are the two phrases that they bring up. Written change, printed addendum. Now, again, not every endorsement is going to cost you extra money, but some of them do, especially if the endorsement is to increase coverage or to add coverage. It's definitely going to cost you money. If you add water sewer backup, that's going to increase the policy. If you add that you're a Lyft driver, you're endorsing the policy to include that you drive Lyft and Uber, it's going to increase a rideshare endorsement. It's going to increase the premium. You're adding extra coverage. So a lot of the questions on the exam about endorsements will be related to the fact that it will cost you extra money, but not every endorsement does. So just keep that in mind. Now, the last part, this isn't technically part of the policy. It's kind of like a separate document. But a certificate of coverage basically is just a document that states that you have coverage. Or even like a binder. A binder is just like, hey, you just bought car insurance, you have coverage. So a certificate of insurance is just a document that states that you have coverage. Okay. All right, I think we talked about everything up here. Yes. Okay, so I know we're running a little bit over the time that we had, but we're almost done with this section. So when you buy the policy, on the declaration page will also be the policy period. How long is this policy good for? So that's the policy period, which is usually car insurance is 6 months, homeowners is like a year. So that's the policy period, how long. The policy territory is just where is the coverage available. Generally speaking, it's the United States, Canada, and US territories, like countries that we own, like Puerto Rico and Guam. The US owns them. We own Puerto Rico, we own Guam, they are ours, but they're not a state. So we just call them US territories. So any United States of America, Canada, and US territories are all places that property coverage exists. Now, when you have homeowners will also come, this is another additional or supplementary coverage on a homeowners, is that you will get worldwide coverage for your stuff. So when you have homeowners, you have coverage C, which is all of your stuff, your clothes, your shoes, your furniture, your pots, your pans. When you're going on vacation, you pack up a suitcase and you take that suitcase with you. Technically, the property territory is US, Canada, and US territories, but let's say you go to Europe, your insurance does have worldwide coverage for your personal property up to 10%. So whatever your coverage C is, and again, we're going to address this more when we deep dive into homeowners, but you have coverage A, coverage B, coverage C. Coverage C is specific to your stuff, my clothes, my shoes, my furniture, my pots, my pans, everything that I own in a house, everything that I would put in a U-Haul if I was moving somewhere else is personal property coverage C. Personal property coverage C comes with a 10% worldwide. which is basically what you would put in a suitcase. So you would put whatever you need in a suitcase to travel anywhere, that is covered at 10%. So that is one of the additional or supplementary. It's not extra money. You're not paying extra money to be able to have suitcase coverage around the world. But it is available on the policy. Policy limits are just how much money is available on the policy. So a policy limit is the most amount of money the insured can collect. So when you're reading your declaration page and they've got coverage A, 100,000, coverage B, 10,000, coverage C, 50,000, these are the policy limits. This is the most that you can collect for coverage A. This is the most that you can collect for coverage B. So the policy limits are the amount of money that you can collect under the policy. Cancellation, we want to know cancellation, the definition of cancellation and non-renewal. When you have a policy, you can decide to cancel it at any time. As the insured, you have a right to cancel your insurance at any point. And cancellation is termination of an in-force policy. So my policy, so think of a policy period. Let's say this is a 1-year period. My policy is starting on this date and ending on this date, and this represents 1 year of time. Cancellation would be ending the policy somewhere along this timeline. Between the start and the end, cancellation would be ending this policy, okay? That's cancellation. Termination of an in-force policy. Termination of an in-force policy. Non-renewal, on the other hand, would say your policy is good for 1 year. We're going to let you finish it, but at the end, no more. Crisscross, X'd out. You're allowed this, but when this is over, there's nothing else. We're not going to give you another one. Typically, insurance just renews. So I have it for a year, I finish, it renews, a year, I finish, renews, I have another year. Non-renewal says they stop that. Yeah, you had a policy and they're not going to give you another one. This is good for 1 year. When the 1 year is up, you can't get another one, go somewhere else. And they non-renew for various reasons. You may have too many claims. You may be in a certain area. Your credit score may be too bad. Who knows? There's rules about when they're allowed to non-renew, whatever. But the thing about non-renewing is that it's at expiration. So they let the policy finish. Cancellation is terminating it during the timeline. If I'm in the timeline, whether I'm 1 month in, 2 months in, 3 months in, anywhere along this timeline, if I cancel the insurance, that is termination of an in-force policy. Non-renewal says we finish it, no more after that. You're not going to get nothing over here. Okay. A deductible is the amount of money that the insured pays first before the insurer pays. This is that retention. So retention is when I retain some of the risk. So retention could be all of it or some of it. A deductible implies some of it. Because if your whole house burns down, it's a $100,000 rebuild. You pay the first 1,000, they pay the rest. That's the deductible. I pay a little bit of the loss and then you pay the rest of it. That's a deductible. The bigger the deductible, the lower your premium. If you want to save money on your homeowners or car insurance, pick a big deductible. It will lower the premium because you're basically saying the bigger the deductible, the more risk you're willing to keep, the more risk you're willing to retain. So the bigger my deductible, the more of the risk I will retain. Think about somebody with the $250 deductible on their car versus a $1,000 deductible. If I go to a parking lot at a grocery store and someone slides a shopping cart along the side and I get this big old scrape. If I have a $250 deductible, I could pay that, take it to a repair shop, even if the total repair is $1,000. If I have a $250 deductible, I can pay the $250. The insurance pays the rest up to the amount, which in this example is $1,000. If I have $1,000 deductible and the damage is $1,000, I'm not going to file a claim. I'm going to pay for it myself. I have retained $1,000 of the first of any crash, accident, damage to the car. So when you are willing to take on more, when you're willing to file less claims because you have a higher deductible, they will honor that by lowering the premium. So the smaller the deductible, the bigger the premium. A person with a $250 deductible is way more likely to file a claim than a person with a $1,000 deductible. So when you go with a $1,000 deductible, you will have a lower premium than someone who has a $250 deductible. And that's why. Okay. All right. Limits. Oh, this kind of goes up here. Control C. When we think of policy, where did that go? When we think of policy limits are what the insured can collect. Limits of liability is the max amount of the insurer is liable to pay. What's interesting is that these two things are the same amount of money. Okay. The most that I can collect is the max that the insurer will pay. Same amount of money. The reason they're different words is because whose viewpoint are we coming from? If we're coming from how much money can I collect, I'm thinking of policy limits. What limits are on my policy? What limits do I have available on this policy? So from the customer's perspective, they think of it as policy limits. From the insurer's perspective, they say, well, what is the max we would have to pay to her? So a policy limit is how much can I collect? Limit of liability is what is the max we have to pay? So it's the same amount of money. The amount of money that I can collect is the same as the insurer will pay, yes. But when it's coming from my perspective as the customer, we say policy limits. When it's coming from the perspective of the insurance company, we say limits of liability. Because remember, liable means I'm responsible for. So what's really interesting about insurance is when we transfer the risk, we're also transferring responsibility. So when I crash into you, I am liable to you to owe you money, but because I have insurance, insurance is now liable to me to be liable to you. We transfer that liability to them as well. So in addition to transferring the risk, I transfer the liability. Because I crashed you, the insurance company has to pay. They're liable to me because I'm liable to you. It's kind of like as a kid, you may mess up, your parent has to come in and clean it up. They have to pay the bill, they have to do something. Your insurance company is like a parent. Oh, parent, I messed up. I burned my house down. Can you fix it? Yeah, we'll fix it. No problem. That's what insurance company, they are responsible for us because they have taken on that role that if you mess up, if you cause problems, you've paid us money, we'll fix it. So policy limit is the most amount of money the insured can collect. Limit of liability is the max amount and the insurer is liable to pay. Same dollar amount, but whose perspective are we coming from? Okay. Other insurance. What if I have more than one homeowners? Is it possible that I can buy State Farm and Allstate at the same time? Yes, I can. I can get both Allstate and State Farm covering my house at the same time. Now, we learned about indemnity, though. Indemnity says I can't profit. I can't make money off of insurance. They're only supposed to restore me to where I was before. So if my house burns down and I have both Allstate and State Farm insuring the house, is Allstate going to rebuild me my house and State Farm rebuild me my house? And now I have two brand new houses? No, that's crazy. Okay. Other insurance is a rule that says if you have more than one policy, each of them will pay a fair share. And the reason for this provision means like a rule, and other insurance is a rule in the policy that says if I have more than one policy, then both insurance companies will pay a fair share in proportion to what they're covering. And there's a whole math problem with that. It's called pro rata. How do we find the fair share? But pro rata is not always a big math question. I have a YouTube video on it if you want to go see how to do the math. But other insurance is the rule that says if there is another policy covering the same structure, each of them will pay a fair share in proportion to the loss. And the reason that we have the other insurance provision is to protect indemnity. We want to protect indemnity, which says you are not supposed to gain, you are only supposed to be restored. All right. Vacancy versus unoccupancy. Now, when we come back to the idea of, we should move this, let's put this next to perils. When we think of the house being covered, when most houses, you should, we're talking about these words, let me stay up here. If you're covering a house, we assume you live in the house. Most people live in their house. So when insurance is covering the house, they assume you live there. They assume that you're in the house. And a house that is lived in will, a house that is vacant is more prone to problems. People vandalizing it, pipes bursting without anybody knowing. When you live there, you're able to see the problems and or scare people away from, throwing rocks and breaking your windows. A house that is empty is more likely to be vandalized than a house that is not empty. That's just, facts about the situation. So insurance companies care if a house is vacant or not. Now, they will cover a vacant house for the first 60 days that it becomes vacant as normal. So when a house is vacant, one, you need to know the definition of vacant, which is no people and no stuff. A vacant house is one with no people and no stuff. All the furniture is cleared out. All the people are gone. It is an empty house. It is vacant. Now, a vacant house will still have all the coverages on it till 60 days from being vacant. On the 61st day, you will begin to lose coverages, specifically coverages that are prone to happen when the house is vacant, like vandalism and pipe bursting. You won't lose all the coverages. If the house burns down, they'll still cover it. But you will lose certain coverages, specifically the ones related to more likely happening if a house is vacant. So vacant, no people, no stuff. Day 61 of vacant, I lose coverage. But it is fully covered for the first 60 days. So if they say a house was vacant for 45 days and it was vandalized, what's covered? All of that's covered. It was only vacant for 45 days. You have up to 60. So if they say it was vacant for 30 days, all the normal coverage. It was vacant for 50 days, all the normal coverage. It was vacant for 70 days. You're losing coverages. Okay. It's after 60. Sorry if that was a loud clap right in the microphone. That was very close. I didn't mean to sound that loud. Anyway, hopefully it wasn't that bad. Vacant is they only care on day 61. Okay. So vacant, no people, no stuff. We care on day 61. If there's no people, no stuff, you begin to lose coverages. Now, on the other side of that, you might say, well, Melissa, you just said that they assume I live at the house. What if I have a vacation home and I'm only there in the summer? I'm not living there for 9 months. That's okay. We understand that there are secondary residences that are not your primary residence. That's fine. We're going to call those houses unoccupied, which is not the same as vacant. Unoccupied says there's no people, but there is stuff. So your summer home still has beds and furniture and all the things. You're just not in it. So unoccupied is just no people, no people, but there is stuff. There is furniture there. You plan to be back. That's another thing about unoccupied is the intent to return. If you are intent to return, you plan to come back, you're only on vacation, the vacation should trigger unoccupied. Because vacation implies I am gone and I will be back. So if they say that the insured went on vacation, is the house vacant or unoccupied? It's unoccupied. It's not vacant. You plan to come back. So unoccupied is no people, but there is stuff, and the people intend to come back like they're just going on vacation. They might throw a couple of questions at you to try to, the questions that you can see on this might be, they're going to say, which of the following properties is vacant? And they'll list out an apartment building that nobody has moved into. That one's vacant. A house where the insured left for 3 months. Well, they left for 3 months. Sounds like they're going to come back. That's unoccupied. Like, you need to be able to read them and figure out which ones are vacant, which ones are unoccupied. And remember, vacancy is no people, no stuff. Unoccupied is no people, but there is stuff. Okay. All right. I think the only other words that we missed here are, I did all those, coinsurance and the car insurance stuff. Yeah. Okay. I just want to make sure. Yes. Okay. I know we haven't fully gone into homeowners yet. But we're going to do that in the next section here. Okay. Now, okay. Coinsurance. Now, technically speaking, because of the way the exam is broken down, there is a general insurance chapter or insurance terms policy provision. Coinsurance is part of that chapter and it's part of homeowners, meaning it's a double dipper. It could be part of the general insurance and at the same time homeowners. So this is something you would need to know for the general insurance chapter, but it is easiest to teach after I have taught homeowners. So I'm going to save that one for homeowners. And then with the rest of them here, the aggregate, the per occurrence and things like that, those again are most understood when we teach car insurance, because these ones go to car insurance. So we're gonna learn these with car insurance. So those will be in those videos or those classes, whatever you want to say. But they're part of these notes because they are specifically tested in this section. And then let's do theft, burglary, robbery, and then we'll be done. Now, theft, burglary, and robbery are not on everyone's exam. I've seen it in some states, not others. Although, while it may not be in the general insurance chapter, these terms do pop up in pretty much everyone's commercial chapter. So it's good to go over them. So whether you've seen them or not in your general insurance, you probably will see these in the commercial side. So we're going to go over them real quick. So first, theft is the act of stealing. That's just the act of stealing. Now, I didn't know that burglary and robbery were different things until it was time to take and study for this test. But they're different things. I think a lot of people will use them interchangeably, but they are technically two different things. Burglary is bursting in, breaking down the door, bursting in, forced entry. That's burglary. So burglary is when you bust in, break down the door, whether or not you steal. Burglary is breaking in, usually with an intent to steal. But if all you do is break the door and then an alarm comes off and you run away, you could be charged with burglary. No theft because you didn't steal anything. If you did come in after breaking down the door and steal things, you would be charged with both burglary and theft. They're two separate things. Robbery is when Rob was there. So robbery says that there was a pertinent person or a witness or a victim. So my memory trick is robbery is Rob was there. You held a gun to a person's head, or they heard you break in and they were scared. If there was another person involved, scared for their life while you were robbing and doing whatever, that's robbery. So if you broke into a house while someone was sleeping in bed to steal their TV, you are guilty of theft, burglary, and robbery, all three, and all three would be separate charges, okay? So it is important to know the difference. Burglary, breaking, robbery, Rob was there. Robbery was a person was there. Okay. All right. So that is it for our this is coming from the PNC Basics chapter. also known as policy provision. If you are in a different state, same, whatever, it's all good and gravy. All right, so let me go ahead and stop the recording here.